I need to tell you about something that almost nobody is talking about, something that could destroy more wealth than the stock market crash of 2008, something that's building right now beneath the surface of financial markets. The bond market, that supposedly safe, boring corner of finance where retirees and conservative investors park their money, is sitting on a powder keg. And I've been quietly repositioning Berkshire Hathaway's massive portfolio to prepare for what I believe is coming, a bond market crash that will catch most investors completely off guard. Today, I'm going to explain exactly what's happening in the bond market, why a crash is not just possible but likely, how devastating it will be when it occurs, and most importantly, what I'm doing to protect Berkshire's capital and how you can protect yours. Because if you own bonds, if you have money in bond funds, if you think you're being conservative by holding fixed income investments, you need to understand that you're sitting on one of the riskiest assets in the market right now. Let me start with a basic truth that most people don't fully understand. Bond prices and interest rates move in opposite directions. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. This inverse relationship is mathematical and unavoidable. If you own a bond paying 3% interest and interest rates rise to 6%, nobody wants to buy your 3% bond at face value. They can get 6% buying new bonds. So your bond's price has to fall until its yield matches current market rates. The longer the maturity of the bond, the more sensitive its price is to interest rate changes. A 30-year bond will fall much more in price than a 2-year bond when rates rise by the same amount. Now, here's the problem we're facing. For over a decade after the 2008 financial crisis, interest rates were at historic lows. The Federal Reserve held the Fed funds rate near zero from 2008 to 2015. They did it again from 2020 to 2022. Long-term Treasury yields fell to record lows, with 10-year Treasuries yielding below 1% at one point during COVID. Corporate bond yields and mortgage rates followed Treasury yields down. This created the longest, most extreme bond bull market in history. Bond prices soared as yields fell. Investors, especially conservative investors and retirees, piled into bonds thinking they were safe. After all, bonds are supposed to be the stable part of your portfolio, the ballast that protects you when stocks crash. But what these investors didn't realize is that at historically low yields, bonds weren't safe at all. They were accidents waiting to happen. And the accidents started happening in 2022 when the Federal Reserve began raising rates aggressively to fight inflation. From March of 2022 to July of 2023, the Fed raised rates from near zero to over 5%. That's one of the fastest rate hiking cycles in history. The impact on bond prices was catastrophic. Long-term Treasury bonds fell by over 30%. Investment-grade corporate bonds fell 20 to 25%. Mortgage-backed securities got crushed. This was a crash, by any definition, comparable to a significant stock market decline. But it didn't get the same attention because bonds aren't as visible as stocks. Most people don't check their bond fund values daily. Many don't even realize they've lost significant wealth. But here's why I'm still preparing for a bond market crash even after this initial damage. Because I don't think we're done. I think interest rates are going to go higher, or at minimum, stay elevated much longer than most investors expect. And when that reality sets in, there's going to be another wave of selling in bonds, potentially even more severe than what we saw in 2022. Let me explain why I believe this. First, inflation is not defeated. The Federal Reserve wants you to believe inflation is under control, back to their 2% target. But look at the actual data. Core inflation is still running above 3%. Housing costs, which make up a huge portion of inflation measures, are still rising. Service sector inflation is sticky. Wage growth remains elevated. The Fed cut rates in late 2024, declaring victory over inflation. But I think they're making the same mistake they made in the 1970s, cutting rates too soon before inflation is truly vanquished. When inflation comes roaring back, and I think it will, the Fed will have to hike rates again, maybe back to 5 or 6% or higher. That would devastate bond prices all over again. Second, the fiscal situation is completely unsustainable. And this is going to force interest rates higher regardless of what the Fed does. The United States government is running deficits exceeding $1.5 trillion annually. The national debt is over $34 trillion and growing rapidly. We're now paying over $1 trillion per year just in interest on the debt. Think about that. $1 trillion more than we spend on defense just to service past borrowing. And it's going to get worse because hundreds of billions of existing debt needs to be refinanced at higher interest rates as old bonds mature. The supply of treasury bonds is exploding. The government needs to issue trillions in new debt every year to fund deficits and refinance maturing debt. But who's going to buy all these bonds? Foreign buyers, traditionally major purchasers of treasuries, are reducing their holdings. China has been selling treasuries steadily. Japan, usually our biggest foreign creditor, has been selling to support its own currency. Domestic buyers are already saturated. The only buyer with unlimited capacity is the Federal Reserve, and if they start buying heavily again, that's money printing, which causes inflation, which forces rates higher anyway. It's a trap with no good exit. When bond supply overwhelms demand, yields have to rise to attract buyers. It's simple economics. If you want to sell more of something, you either improve the quality or lower the price. The U.S. government can't improve the quality of treasuries. So yields will rise, which means prices will fall. This isn't speculation, this is mathematics. The bond market will crash simply from the weight of supply. Third, the term premium has disappeared, and it needs to come back. Term premium is the extra yield investors demand for holding long-term bonds versus short-term bonds. Normally, you expect higher yields on 30-year bonds than 2-year bonds because you're taking more risk by locking your money up for 30 years. But during the QE era, when the Fed was buying bonds aggressively, term premiums compressed to near zero or even went negative. Investors weren't demanding adequate compensation for duration risk. Now that's changing. As the Fed stops buying bonds and potentially sells bonds from its balance sheet, as fiscal deficits explode, as inflation risks remain elevated, investors are starting to demand higher term premiums. Long-term bond yields need to be significantly higher than short-term yields to compensate for risks. If short-term rates are 4 to 5%, long-term rates should probably be 6 to 7% or higher. That implies 30-year Treasury bonds need to fall another 15 to 20% from current levels. And if it happens quickly, which these adjustments often do, that's another crash. Fourth, there's massive hidden leverage in the bond market that could trigger a cascade. Many investors own bonds through mutual funds or ETFs. Those funds generally aren't leveraged, but many institutional investors, hedge funds, pension funds, insurance companies, they use leverage extensively in bond markets. They might borrow money at short-term rates to buy long-term bonds, capturing the spread. This works great when rates are stable or falling, but when rates rise and bond prices fall, leveraged investors face margin calls. They're forced to sell bonds to meet margin requirements, which pushes prices down further, triggering more margin calls. It becomes a self-reinforcing crash. We saw a preview of this in the UK in September of 2022. British pension funds had used complex leverage strategies in the bond market. When UK government bond yields spiked after the government announced fiscal stimulus, these pension funds faced massive margin calls. They were forced sellers of bonds at the worst possible time. The selling accelerated the yield spike, which triggered more margin calls. The entire UK financial system was hours away from collapse before the Bank of England intervened with emergency bond purchases. That was a small market compared to U.S. Treasuries. Imagine the same dynamic playing out in the much larger, more interconnected U.S. bond market. Fifth, banks are sitting on huge unrealized losses on bonds, and this creates systemic risk. Banks bought enormous quantities of Treasury bonds and mortgage-backed securities when yields were near historic lows. As rates rose, the market value of those bonds fell dramatically. The FDIC estimates that U.S. banks collectively hold over $600 billion in unrealized losses on securities. $600 billion They don't have to recognize these losses immediately because of accounting rules that allow them to hold bonds at amortized cost rather than market value. But those losses are real. If banks need to raise liquidity, if they face deposit withdrawals and need to sell bonds, they have to recognize the losses. This is what killed Silicon Valley Bank, Signature Bank, and First Republic in March of 2023. They had huge bond portfolios underwater. Depositors got nervous, started withdrawing, and the banks had to sell bonds at losses to raise cash. Once the losses were recognized, the banks were insolvent. We could see many more bank failures if there's another leg down in bond prices. So those are the reasons why I believe a bond market crash is coming or will continue from where it already started. Now let me tell you what I'm doing about it at Berkshire Hathaway, because our positioning has changed dramatically over the past few years. First and most importantly, I've kept Berkshire's bond holdings extremely short duration. We hold over $300 billion in cash and short-term treasury bills. These are securities maturing in less than 1 year, most maturing in 3 to 6 months. We earn about 5% on these holdings, which is decent. But the real advantage is that we have minimal interest rate risk. If rates rise, our treasury bills mature soon and we can reinvest at the higher rates. We benefit from rising rates rather than being hurt by them. If rates fall, yes, we'll have to reinvest at lower rates, but we won't suffer capital losses the way long-term bondholders will. This positioning gives us maximum flexibility with minimum risk. Every time one of our treasury bills matures, we decide whether to roll it into new short-term bills or deploy the capital elsewhere. We're never locked in. Compare this to what I could have done. I could have bought 30-year treasury bonds in 2021 when they yielded around 2%. If I had, those bonds would now be down over 40% in value. I would have lost over $100 billion on paper. By staying short, I avoided that catastrophic loss. Now, some people say I missed the yield. Yes, 30-year bonds paid 2% back then, but I'm now earning 5% on treasury bills, and if rates rise further, I'll earn even more. The flexibility of staying short is worth far more than the small extra yield I could have earned going long. Second, I've avoided corporate bonds almost entirely. Berkshire holds virtually no corporate bond portfolio. Why? Because corporate bonds have two types of risk: interest rate risk and credit risk. When rates rise, corporate bond prices fall, just like treasuries. But corporate bonds also face default risk, especially as the economy weakens. Corporate debt is at record levels. Much of it was issued when rates were near zero, and now companies need to refinance at rates 2 or 3 times higher. Many won't be able to afford it. Default rates are going to rise, which will cause credit spreads to widen, which will make corporate bond prices fall even more than treasury prices fall. I don't need that risk. The extra yield you get from corporate bonds versus treasuries doesn't compensate for the credit risk, especially this late in the cycle. If treasury yields are 5% and investment-grade corporate bonds yield 6%, that extra 1% is not worth the risk of default losses and price volatility. I'll take the treasuries, keep them short, and sleep well at night. Third, I position Berkshire's operating companies to benefit from higher rates rather than being hurt by them. Our insurance companies are major beneficiaries of higher rates. We collect premiums, invest the float, and higher rates mean higher investment income. Our float is over $160 billion. At 5% interest rates, we earn over $8 billion annually from the float. That's pure profit with no effort. If rates go to 6 or 7%, our investment income increases proportionally. Higher rates are good for our insurance operations. BNSF Railway, our freight railroad, has minimal debt relative to the value of the business, so we're not burdened by refinancing risk. Berkshire Hathaway Energy has debt at the subsidiary level, which is typical for utilities, but it's mostly fixed rate debt locked in years ago at low rates. We're not facing refinancing problems. Most of our operating companies generate significant free cash flow and have little or no net debt. We're not vulnerable to the credit crunch that higher rates will cause for more leveraged companies. Fourth, I've been selling stocks that are vulnerable to rising rates and buying stocks that benefit Technology stocks with high valuations are extremely sensitive to interest rates because their value depends on profits expected many years in the future. Rising rates reduce the present value of those future profits dramatically. I've trimmed our Apple position significantly over the past year, selling over half our shares, not because Apple's a bad business, but because at those valuations with rates rising, the risk reward didn't make sense. Meanwhile, I've been buying companies that benefit from higher rates. We've increased positions in financial companies that earn more when rates rise. We've bought more energy stocks, which are not particularly rate sensitive. We've focused on businesses with current cash flows rather than distant future profits. This portfolio rotation protects us from rising rate impacts while positioning us to benefit where possible. Now let me talk about what individual investors should do, because most people are dangerously exposed to bond market risk without realizing it. First, look at your portfolio. If you own bond mutual funds or bond ETFs, look at the average duration. Duration measures interest rate sensitivity. A bond fund with a duration of 10 years will fall about 10% in value if interest rates rise by 1%. If you own long duration bond funds and rates rise another 2%, you could lose 20% of your capital. That's not conservative. That's speculative. If you need fixed income exposure, keep it short. Buy individual treasury, bills directly through Treasury Direct. Buy short-term bond funds with durations under 2 years. Buy money market funds. These don't offer much protection against inflation, but they also don't expose you to catastrophic losses from rising rates. So if you're going to lose purchasing power to inflation, at least don't also lose nominal capital to bond price declines. Second, reconsider the traditional 60-40 portfolio allocation, 60% stocks and 40% bonds. This was a standard recommendation for decades because stocks and bonds historically moved in opposite directions. When stocks fell, bonds rose, providing diversification and stability. But that relationship broke down in 2022. Stocks fell and bonds fell simultaneously. Both asset classes lost money because rising rates hurt both. In an environment of rising rates, the 60-40 portfolio is a disaster. You're exposed to equity risk in the stock portion and interest rate risk in the bond portion. There's no diversification benefit. You need to rethink allocations. Maybe it's 70% stocks and 30% cash. Maybe it's 80% stocks and 20% short-term bonds. Maybe it's some allocation to real assets like commodities or real estate. But the traditional bond allocation needs to be reconsidered. Third, be especially careful with bond funds versus individual bonds. If you own an individual treasury bond and rates rise, your bond's market value falls. But if you hold it to maturity, you get your principal back. You only suffer a loss if you're forced to sell before maturity. But if you own a bond fund, there is no maturity. The fund continuously holds a portfolio of bonds. When rates rise, the fund's value falls and it doesn't automatically recover. You've actually lost capital, not just suffered a temporary price decline. Individual bonds have this hold to maturity option. Bond funds don't. If you absolutely must own longer term bonds, buy individual securities and commit to holding them to maturity. At least then, you'll get your principal back even if market values fluctuate. Don't make the mistake of thinking bond funds are equivalent to individual bonds. They're not, and the difference matters enormously in a rising rate environment. Fourth, understand that bonds are no longer the safe haven they used to be. For decades, the advice was that as you get older, you should shift from stocks to bonds to reduce risk. But that assumes bonds are less risky than stocks. At historically low yields, with massive fiscal deficits and inflation risks, bonds might actually be riskier than stocks over the next few years. Stocks represent ownership of real businesses that produce goods and services. If inflation stays elevated, quality businesses can raise prices and protect real value. Bonds are fixed claims on currency. If the currency loses purchasing power, bondholders are destroyed. I'm not saying everyone should dump all bonds and buy all stocks, but I am saying you need to rethink the assumption that bonds are automatically the conservative choice. In this environment, holding cash or very short-term bonds might be more conservative than owning long-term bonds. and holding quality stocks might be more conservative than owning long-term bonds. Let me address the argument that I'm being too pessimistic, that the Fed will cut rates aggressively if the economy weakens, which will support bond prices. Yes, if we have a severe recession, the Fed will cut rates and bond prices will rise. That's true. But here's the problem with depending on that scenario. If the Fed cuts rates back to zero and restarts money printing, inflation will accelerate again. You might make money on your bonds in nominal terms, but you'll lose purchasing power in real terms. Is that really a win? The scenario that concerns me most is stagflation, where we have weak economic growth combined with elevated inflation. In that environment, the Fed is trapped. They can't cut rates aggressively because inflation's too high, but the economy's weak, so they can't raise rates further either. They're stuck, and bond investors are stuck with inadequate yields that don't compensate for inflation. Bond prices don't crash dramatically in this scenario, but they stagnate while inflation erodes real value. You're slowly destroyed rather than quickly destroyed. Neither outcome is good. The only positive scenario for long-term bonds is if the Fed successfully crushes inflation and we return to the low-rate environment of the 2010s. That's possible. But it would require the Fed to keep rates elevated until inflation is truly defeated, which means accepting a recession and higher unemployment. Then they could cut rates back to low levels without reigniting inflation. In that scenario, long-term bonds bought today at 5 to 6% yields would be great investments, but I don't think the Fed has the political will to do this. I think they'll cut rates prematurely, inflation will resurge, and they'll be forced to hike again. That's the more likely path, and it's terrible for bonds. There's one more point I need to make about the bond crash that's particularly important for retirees and near retirees. Many retirement planning models assume bonds will provide stable income with minimal risk. Financial advisors have told clients for decades to shift into bonds as retirement approaches. Millions of people have followed this advice. They put significant portions of their retirement savings into bond funds, thinking they were being prudent and conservative. Those people are sitting on large unrealized losses right now, and if rates rise further, those losses will deepen. The tragedy is that many of these people are withdrawing from their portfolios to fund retirement expenses. So they're not just suffering paper losses, they're being forced to sell bonds that have fallen in value to raise cash for living expenses. They're locking in losses. And once you sell at a loss, you can't recover. The damage is permanent. This is a catastrophe for a generation of retirees who thought they were doing everything right by being conservative. If you're in this situation, if you're retired or near retirement and holding significant bond fund positions that are underwater, you need to make some hard decisions. Can you reduce spending temporarily to avoid selling bonds at losses? Can you live on Social Security and other income sources until bonds recover? Can you work part-time to supplement income? These aren't fun options, but they might be necessary to avoid locking in permanent capital losses. Alternatively, and this is painful, but might be right for some people, you might need to recognize the losses, sell the bonds, and repositioning into short-term securities or other assets with better prospects. Taking a loss is never pleasant, but sometimes taking a loss and moving to a better position is the right choice. If you think rates are going higher, staying in long-term bonds, hoping they recover, might mean years of waiting and opportunity cost. Sometimes you have to cut your losses. I've been investing for 75 years. I've seen bond bull markets and bond bear markets. I've seen low inflation and high inflation. I've seen low rates and high rates. And what I'm seeing right now in the bond market concerns me as much as anything I've seen in my career. The fundamentals are terrible. Supply is overwhelming demand. Fiscal policy is unsustainable. Inflation risks remain elevated. The term premium needs to normalize. Hidden leverage creates crash risk. And most investors are positioned as if rates will stay low forever, which they won't. I've positioned Berkshire to weather a bond crash. I've kept our fixed income extremely short term. I've avoided credit risk. I've positioned our operating companies to benefit from higher rates. I've rotated our equity portfolio away from rate-sensitive stocks, and I'm sitting on over $300 billion in cash and short-term treasuries, ready to deploy when opportunities appear. Whether that's buying stocks after a crash, acquiring entire companies at distressed prices, or even buying long-term bonds, if yields spike to truly attractive levels, I'll have the firepower to act. That's the position of strength that comes from preparing for a crisis rather than being caught off guard by it. If you're a bond investor, if you're holding long-term bonds or bond funds, if you think you're being conservative and safe, I urge you to reconsider. Look at your duration exposure, understand your interest rate risk, consider shortening maturities, think about alternative ways to achieve stability in your portfolio without the rate risk of long bonds. Because what's coming in the bond market, whether it's a dramatic crash or a grinding bear market, is going to destroy wealth on a massive scale. And the tragic part is that most of the wealth destruction will happen to people who thought they were doing the right thing, who thought bonds were safe, who trusted the advice they received. They'll be the victims of the biggest bond crash in a generation. Don't be one of them.